gold this week traded below 4,000. The low on gold was $3,970. In fact, silver dropped 11.3% on the week, $55.99. Alan Greenspan, who really was the architect of the housing bubble, passed away this week. He was the Fed chairman. He was the maestro well before the dot-com bubble. He inflated the dot-com bubble. When he was testifying before Congress and asked about the gold standard, he said that he used gold as his main indicator. If $400 gold meant the Fed needed to hike rates, what does $4,000 gold mean now? They're way behind the curve. The Fed needs, massive rate hikes, quantitative tightening. This is a great buying opportunity. Yes, this week both gold and silver went down, but they're totally different assets. One of them is a buy, gold and silver. Bitcoin is just air coming out of a bubble. I do expect oil prices to reverse and go up. But in the meantime, hey, that's still good news for the gold and silver mining stocks. It wasn't just Fool's Digital Gold that had a rough week. It was gold itself. Real gold also went down quite a bit. In fact, gold this week traded below 4,000. The low on gold was $3,970. Now, we didn't close below 4,000. We had a little bit of a recovery the past couple of days. So all of that decline took place Monday through Wednesday. That's how bad it was. Gold closed today up about $62 at $4,088.60. Silver down even more. In fact, silver dropped 11.3% on the week, but it closed significantly off the low. Silver got as low as $55.99, so a penny below 56. It closed at $59.05, so still below 60, but it was a big shakeout in gold and silver. I think we hit a lot of stops because I think some people might have had stops not just below the low, but below 4,000. And when gold was below 4,000, and it spent 2 days during the week where it traded below 4,000, Wednesday and Thursday, sentiment got very, very negative on gold. And it's as oversold as it's been in many, many years. In fact, I think it's more oversold now than it was overbought when it was at 5,600. So I think that negative sentiment hitting those stops, there's a good chance that that's been it, that's the bottom of this decline. Silver, never got back down to 50. I don't expect it to get down to 50. And honestly, I didn't think it would get this low, but it did. But given the context of the bull market, $59 silver compared to where it was a year ago, this is a huge bull market. It is a big breakout. Yes, silver is down more than 50% from its peak, but it tripled before the drop. So silver went on a rally that I've never seen in my career, where in a very short period of time, it went from 30 to 120. So the fact that it pulled back, and again, remember, the catalyst for the pullback was the war. The war started, and it was a buy the rumor, sell the fact, because part of the reason for the rally in precious metals was the anticipation of the war. Then the war started, and it was already overbought, and we had a buy the rumor, sell the fact. And by the way, I want to mention that Alan Greenspan, who really was the architect of the housing bubble, passed away this week at the old age of 100. So he lived a long time, but unfortunately, I guess not long enough to really see the consequences of what he set off, because he wrote this playbook.
Many analysts believe major financial bubbles are often fueled by prolonged periods of easy money rather than investor optimism alone. When borrowing remains inexpensive and markets expect continued policy support, risk-taking can increase and asset prices may become detached from underlying fundamentals. For long-term investors, understanding how monetary policy influences market behavior can be more valuable than reacting to short-term headlines.
He was the Fed chairman. He was the maestro. from well before the dot-com bubble. He inflated the dot-com bubble. He inflated the housing bubble. He left town and handed it over to Bernanke before the housing bubble popped. But I always blamed it on him. When I talked about all of the players, and, I blamed, congressmen because I was blaming Fannie and Freddie. I was blaming HUD. I was blaming government guarantees, guaranteed mortgages, guaranteed bank accounts. There was all sorts of ways government created moral hazard and directly contributed to the housing bubble or inflated the housing bubble. And that's why I knew that we were going to have a crisis when it popped. But I would talk about various people, but I always said that Greenspan was the ace of spades in the deck. He was the number one guy that bore the most responsibility. And he was the most knowledgeable Fed chairman we've had. He was a smart guy. He was a Ayn Rand disciple. I mean, he wrote this great essay, Gold and Economic Freedom, that was included in her book, Capitalism, the Unknown Ideal. And if you haven't read that essay, read it. In fact, Ron Paul, used to confront him, or he confronted him at one point, walking around Congress, and he asked him if he would, change anything in that essay now. And he said, I wouldn't change a word. And in that essay, he basically blamed the entire stock market bubble and crash in 1920 on the Fed, and for printing too much money and for keeping interest rates too low. And he advocated for a gold standard. He said that gold and economic freedom are inseparable. They go hand in hand. He was a very big critic of the Federal Reserve.
Markets often react to expectations of future policy instead of long-term economic realities. While short-term moves are frequently driven by central bank headlines, many analysts believe broader trends such as debt growth, inflation, and monetary expansion have a greater influence over time. Investors who focus on long-term fundamentals rather than daily market swings may be better positioned to navigate periods of uncertainty.
And that meant he was still a critic. The arrogance of Greenspan was that he believed that he could use his own judgment to create a de facto gold standard. And that's what he said he was doing. When he was testifying before Congress and asked about the gold standard, he said that he used gold as his main indicator. He said that if gold is up to $400 an ounce, it means I'm too loose and I got to raise rates. If gold goes below 300, I'm too tight and I got to cut rates. So he was claiming that even though we weren't officially on a gold standard, unofficially we were, because he was using gold as a way to know whether he had the interest rates right or wrong. Because how are you supposed to know? You just can't guess. You need some kind of market indication. And Greenspan said the best indicator of whether or not you have interest rates too high or too low is the price of gold. Well, if 4,000 meant he was too loose, if $400 gold meant the Fed needed to hike rates, what does $4,000 gold mean now? It means they really need to hike. They're way behind the curve, right? Based on Greenspan's criteria, the Fed needs, massive rate hikes. Quantitative tightening. So he was the best one as far as understanding, yet he still made these mistakes. He still chose inflation over the alternative. When the stock market crashed in 1987, Greenspan chose inflation, right? So if a guy like Greenspan, a gold bug, when push comes to shove, if he chooses inflation, why is Warsh going to be any different? He's not. And so the markets, gold and silver, are pricing in rate cuts that are probably never going to happen. We're going to have, rate hikes. The market is pricing in rate hikes that aren't going to happen. And so this is a great buying opportunity. Yes, this week, both gold and silver went down, but they're totally different assets. And one of them is a buy, gold and silver. Bitcoin is just air coming out of a bubble. And so what are the opportunities that people have who are still in Bitcoin or in strategy or stretch? You can sell.
Short-term market corrections often create opportunities that disciplined investors recognize before the broader market does. Rather than chasing recent winners, many analysts emphasize focusing on valuation, long-term fundamentals, and purchasing power. History shows that successful investing is often driven by patience and careful asset allocation, not by reacting to temporary price swings or market sentiment.
And then you could take your money and you can buy gold and silver that have also gone down. Because Bitcoin's not going back up to make a new high at 120,000 from 60,000, but silver can easily go from $60 to 120 bucks. So you'll make your money back even if you bought Bitcoin at 120,000. You don't have to make that money back in Bitcoin. You can get out of Bitcoin, take a tax loss, put that in your pocket, and maybe even file a lawsuit if you just bought Bitcoin, I don't know, but if you bought Strategy, you can. But you take your tax loss, and now you buy some silver. And when silver doubles back to its old high, now you're even, right? Instead of losing more money. And I don't think silver is going to stop there. I think silver's got a long way to go. I think 120 will just be a stop on the way to 200 over time. So you can make back your losses from crypto and fool's gold by getting into the real thing. Anyway, oil prices, big drop this week. Oil back down, actually below $60. Or was it below, let me see, below $70, excuse me, $69 is where oil closed. So I didn't think it would fall this much. I don't think it's going to stay down here, though. Yes, the war supposedly is over, but who knows? It could restart at any minute. But there's a ceasefire. There are ships that are going through the strait for now. But I think this is just a short-term overshoot on the way down. I do expect oil prices to reverse and go up. But in the meantime, hey, that's still good news for the gold and silver mining stocks because they were having to pay a lot of extra money. That's their biggest cost is energy, and that's come down. By the way, the GDX and GDXJ on the week, they were down about 5% each, well off their highs. But there's a good chance, I think, that they've seen their lows. Bond yields were off a little bit, but not very much. I mean, given the big drop in the price of oil, not much relief in the Treasury bond market. The yield on a 10-year closed at 4.37. The high was about 4.5, and the 30-year is 4.86. So it was just about 5. So very little relief there. So I think we still have a long way to go higher in Treasury yields, which is another reason that the Fed is going to continue to expand its balance sheet. And by the way, it's still expanding. If Warsh was real serious, he would be shrinking the balance sheet right now. It's still expanding. Money supply is still growing. The Fed is still creating inflation. How are you going to fight what you're creating? So again, it's all talk. You got to look at what the Fed does, not at what they say, because talk is cheap. They're trying to buy some credibility with tough talk, because the Fed also places a lot of stock in expectations. They think that inflation is a function of expectation.
Long-term market trends are often shaped more by monetary actions than by official statements. Many analysts believe investors should pay closer attention to liquidity conditions and central bank balance sheets than to policy headlines alone. When actions and messaging diverge, markets tend to respond to the underlying flow of money, making long-term monetary trends an important factor for understanding inflation and asset prices.
And if they can get people to expect less inflation, then they think we'll get less inflation. By the way, we did get the consumer sentiment numbers out, and consumers are looking for inflation over the next year at 4.6%. So way above the 2%, but it is lower than the 4.6% that they expected the prior month. And the actual number, the consumer confidence number, is 49.5. So below 50, it's still a very low number, but not quite as bad as the 48.9 from the prior week. In fact, I think the worst economic news that came out today was our trade deficit in goods, which came out at 105.8 billion, which was substantially above what had been expected. I think it was a 28% increase from the prior month for the the trade deficit, and it happened as a result of a decline in exports by 5.4% and an increase in imports. Imports went up by 3.6%. So this is the worst trade deficit in goods since March of 2025. So Trump promised that his tariffs were going to reduce our trade deficits. The trade deficits are rising. This is the biggest goods trade deficit in over a year, and it's headed in the wrong direction. And we lost twice. Imports up, exports down. But I want to finish this up. I want to talk about this interview that I heard. I was on CNBC, and I forget the congressman, and he was talking about this, and he was repeating these myths of economics on what we need to do to boost the economy. And one of the things that he claimed credit for creating the middle class was the GI Bill, kind of saying we need something like the GI Bill, because the GI Bill, the government, gave, vets who were in the war money, they sent them to college, gave money for houses, and claimed that that's where the economic growth came from. And no, it's not. Economic growth is not a function of government redistributing wealth. We would have had even more government growth if we didn't have the GI Bill. But the government likes to claim credit for what would have happened anyway, and in fact, what would have happened better without what they did. And so it wasn't necessary.
Official statements often emphasize fighting inflation, but policy decisions must also consider economic growth and financial stability. Many analysts believe central banks frequently face difficult trade-offs between controlling inflation and supporting markets during periods of stress. For long-term investors, understanding how policy choices affect purchasing power and asset values can be more important than focusing on short-term market reactions.